Hello and welcome to today's presentation of the 2018 Tax Reform Act, the Tax Cuts and Jobs Act. Our speaker is Ed Newton, the senior partner at NewtonAssociatesCPA. NewtonAssociatesCPA is a certified public accounting firm based in the Ballantyne area of Charlotte, North Carolina, and the firm has clients in more than 20 states as well as multiple clients with foreign income interests. Ed's been a CPA for more than 40 years, and during this time, he has seen many changes in the tax laws and is positioned to provide an explanation of this most recent overhaul of the tax code. Ed and his wife reside in Charlotte. He has 3 children and 6 grandchildren. Ed, welcome to the call.
Well, thank you, Jeff. I appreciate that. And welcome to the call to everyone else. I want to add my welcome. And we've got a snowy day here in Charlotte. I'm not sure where you may be listening from since we do have clients across the country. But we do have a snowy day in Charlotte and made it into the office without any problem. But I think we may cut out a little bit early today. And, of course, what we call a snowy day in Charlotte is nothing compared to, example, Jeff's up in Indianapolis, and he said it's been below zero for the last 2 weeks. So I can't complain, I guess. At any rate, before we get started, I wanted just a couple of housekeeping items, if you will, to talk about. At Newton Associates CPA, we always strive to meet your needs, but I want to remind everyone that your individual family or business tax situation is certainly unique to you. Certain aspects of what we talk about today and what's in the Tax Act may not apply to you and certainly doesn't apply in all circumstances. So what I would suggest is that if you have any questions or any assistance that we can provide in understanding the new tax measures, please feel free to give Kristen a call, Kristen Hensley in our office, 704-552-8689, or you can email her directly, kristen@NewtonAssociatesCPA.com. President Trump signed the tax reform bill into law on December 22nd. It was supposedly a Christmas present for us. It makes major changes to the U.S. tax code for both individuals and corporations. In fact, the bill represents the most significant tax changes in the United States in more than 30 years. And as Jeff said, I've been a CPA for over 40 years, so I definitely remember the huge tax change in tax code, in fact, new tax code completely in 1986. And we really haven't had the changes since then that we do have in this bill. With that in mind, I want to just go through some of the changes that will go in effect, let you know that most of them will be effective for 18 and beyond. There's a couple that will be not until 19, and we'll talk about those specifically. Also want you to know that many of these are temporary. So a lot of them expire in 2026, so they go through December 20 of 25. This is especially true for those affecting the individuals. A lot of the individual provisions sunset at the end of 2025. I do want to say that those of you that have a W-2, wages, etc., the IRS says that you do not need to make any changes to your W-4 to reflect the differences in the tax law. They are supposed to have those new tables out to all employers, and the employers will start using those tables. I believe right now they're saying after February 1st. So you may not see any change in your paycheck on January 1st, but you should certainly see it sometime after February. But again, don't expect big changes. You'll see some, but not big changes by any means. First thing I want to do is look at individuals, and then we'll look at some of the business provisions towards the end of our talk. As an overview, some things that have changed. The tax schedules or brackets have been modified. The standard deduction has been increased, but along with that, the personal exemptions have been eliminated until 2026. So again, that's one that we'll talk about more. We'll talk about more in all of these, but just to give you an overview. But the personal exemptions are totally eliminated beginning in 18. Itemized deductions, Schedule A, as people generally talk about them. There have been several modifications to that, and we'll go over those. The estate and trust taxation has been modified a little bit, and both of the modifications, major modifications that have happened, will be advantageous to taxpayers. Alternative minimum tax, sorry folks, it's still there. They had said that they were going to get rid of it. That was one of the tenets of Trump's plan, and it does remain. So we still have the alternative minimum tax, but again, they've made some changes that should make it where a lot of folks are no longer subject to the AMT. And then we'll talk about some other provisions. So let's first talk about the tax schedules and the tax rates that have changed. The changes to the marginal brackets vary depending upon your income and filing status, and the next slide will show that when we get there. But certain taxpayers may see a bump in their marginal rate actually, and that again is because of the change of the tax brackets. But the tax rates have been reduced. You can see here the differences. The smallest break, if you will, is 1% less. That's in the 33% bracket down to 32%. And the widest is in the 28% bracket, which is dropped to 24%. President Trump wanted only 3 brackets. The House started out with their bill, and I believe they had 5. The Senate wanted full 7, and in order to get it passed, they did have to go with the 7 brackets. So we do still have 7 brackets, although they are reduced a little bit. On this next slide, the tax rate schedules and brackets, you can see the brackets on the right-hand side, the income levels, for those filing as single and married filing joint. And those have been expanded significantly. I did not want to put up the comparison between the 2 years because it would have been confusing. Just know that the brackets have widened, so it's very likely that not only will your rate drop because of the change in the rates, for example, from the 28 to the 24%, but it could even drop you down into the 22% bracket. So that's where I think we'll see the most folks get the greatest benefit will be the widening of the bracket. At this point, I do want to talk a little bit about the marriage penalty. I don't know if you're familiar with the marriage penalty. You've probably heard it on television hundreds of times. But if you're not familiar with it, I've tried to come up with like a simplified version of how the marriage penalty works. So let's say that there's 2 single individuals, each earning a taxable income of $90,000 each. Under the old 2018 brackets, in other words, what we would have had for tax brackets had it not been for the tax change, both of these individuals would fall into the 25% bracket for singles. However, if they got married, their combined income of $180,000 would push them into the 28% bracket. Under the new brackets, they would fall into the 24% marginal tax brackets, regardless of whether they got married or not. And you can see, if you look at those brackets, that they are pretty much doubled. Well, they are doubled up until you get to that 33% bracket. So the top 2 brackets, or anyone making over $400,000, is where there is still a slight marriage penalty. Some other sweeping changes that have been made. This is being sold as a tax cut. However, the higher standard deduction really falls more into a category of simplification, I think. Yes, the standard deduction has roughly doubled for all filers, as you can see here. It hasn't quite doubled, but it's pretty close to being doubled for everyone. But the valuable personal exemption has been eliminated, and we're going to talk about that in just a couple of seconds here. But I wanted to let you know that those personal exemptions have been eliminated, which does lessen the impact of the standard deduction. So, for example, a single filer who would have been entitled to a $6,500 deduction and a $4,150 personal exemption in 2018, that would be a total of $10,650 in income exclusions. However, under the new plan, they would get just a $12,000 standard deduction. Is it better? Yes, it is, but it's certainly not double. Having said that, here's a comparison between the standard deductions of the new and the old tax law. So you can see those there and see what the increase is there. Also, we do see that the ACA mandate has been repealed beginning in 2019. Notice that that is 2019, not 2018. So if you are subject to the Affordable Care Act, or Obamacare as people seem to be calling it, you still have the mandate to have the coverage in 2018 and will be subject to the penalties if you do not have coverage for the year 2018, but those penalties will go away in 2019. Let's talk a little bit more detail about some of the itemized deductions. The home debt-related deductions. This one I think is very important for folks to understand. If you have a home equity loan, in the past, we have been able to deduct that as mortgage interest expense. However, it did not matter what you used the money for. So there were, years ago, I know, I've done it many times, folks would say, I've got a home equity loan, and I'm going to buy a car and I'm going to pay for it, but should I just borrow it from my home equity loan? And at that time, it was better than borrowing it from the bank itself for an auto loan, so that you would be able to deduct the interest on the home equity, but you would not be able to on an auto loan. That is completely gone for 2018. So let me please, I want to emphasize that the home equity loan interest is no longer deductible, no exceptions, and no grandfathering. So if you have a home equity loan right now, the interest that you pay on that, even if you don't make any changes to it other than continue to pay it off, that interest will not be deductible. The second provision under home mortgage interest is the reduction limited to $750,000 of corresponding principal debt. This applies to homes purchased after December 15, 2017. The prior law was $1 million of mortgage principal. The interest on that could be deducted. Now it's $750,000. So if you can still have multiple residences, but you have to keep it below the $750,000. Anything above the $750,000 you will not be able to deduct. And like I said, this is just applies to homes purchased after December 15th. So there is a grandfather there. If you do have a mortgage right now with a balance of somewhere between $750,000 and $1 million, you will still be able to deduct all of that interest. And that was my last point there. And again, that is subject to a binding contract exception. So if you were under a binding contract on December 15th, but did not close until January, for example, you still have that $1 million exclusion. State and local income tax. Boy, have we not heard a lot about this one. It has been limited now to a total of $10,000. So that is all of the state and local taxes that we've been able to deduct in the past. So, for example, that would be your state and local income taxes. It would be your property taxes on your home. It would be your automobile taxes that we pay in North Carolina and many other states have a tax. And when I was in Georgia, we used to call it the ad valorem tax. But the personal property tax, all of that is now limited to $10,000. So it's still fully deductible when related to business activities. It's just on the personal side. Also, you probably heard in the media about the IRS coming out with this news release saying that the deductibility of prepaid real property taxes in 2017 depends on whether the tax was assessed and paid prior to 2018, and that is Internal Revenue Notice 2017-210. It is my opinion and the opinion of many other tax professionals that an IRS notice is strictly that. It's nothing more than a press release. It tells you what the IRS position is on a particular topic. However, it has no effect of law. I want to say that again, it has no effect of law. Many tax professionals are of the opinion that anything prepaid back in 2017 for 2018 will be deductible in 2017, and that is the position that our firm will take. Personal casualty and theft loss deduction, we don't see many of those at all because most of our clients do have insurance that cover them for most all casualties and theft losses, but that has been reduced to the extent of personal casualty gains. So again, that line in the Schedule A for personal casualty losses is gone. The losses incurred from federally declared disaster are still allowed, though, so anybody that has those can still deduct them. Other deductions disallowed, just run through these relatively quickly. The foreign real property taxes, now what that means is if you have real estate in a foreign country, you are not allowed to deduct those taxes. Alimony paid. I do want to spend a little bit of time on alimony because that has gotten a little bit confusing to folks. The alimony received is no longer included in income, and let me get all the way through it before you think, uh-oh. However, that only applies to agreements entered into after December 31st, 2018. So it doesn't take effect until alimony agreements actually consummated in 2019. The only exception to that is, and I'm not sure why anybody would do this, however, between now and December 31st of 2018, if you come to an agreement with the two ex-spouses come to an agreement to modify the alimony order, and you put in the order that this will be now subject to the alimony law for 2019, then it would then become non-deductible by the payer and non-income to the person receiving the alimony. So let me just go over that briefly one more time. Anyone that's paying alimony now, if you're paying the alimony, it's still a tax deduction. If you're receiving alimony, it's still income. If you change the order of alimony and specifically state that it is to be non-deductible by the payor and non-income to the payee in the order, then it does become non-deductible by the payor. Any alimony order entered after 12/31/2018 will not be deductible by the payor and is not taxable to the person receiving the money. Moving on to moving expenses, I was a little surprised at this one, but they have, under the new law, no deduction for any moving expenses and no exclusion for reimbursed moving expenses. So if your employer does pay for your move, you will pay tax on that money going forward and will not get a deduction on your personal tax return. Miscellaneous itemized deductions, completely gone. Tax preparation, what? Tax preparation fees no longer deductible? That can't be. Sorry, I had to put a little humor in there. Tax preparation fees are not deductible investment expenses, safe deposit box, etc. This is going to really affect a lot of folks. And as you may know, we do quite a few airline people's tax returns. And so for the airline people, that you're going to lose all of those deductions you had. That means your union dues, your per diem expenses, your telephone, all of the expenses related to your flying are gone. It also applies to any other employee types that have employee business expenses, and we typically have quite a few of those as well. You may think of it you may hear the word Form 2106. If you have 2106 expenses, those are no longer deductible. I'm hoping that they'll change that at some point. I don't see them changing it for 2018, but this is a huge effect on a lot of folks, and hopefully they'll change that. And then amounts paid for college athletic seating rights. Those of you that are making payments to secure better seats for your football games or your basketball games, those amounts are no longer considered a deduction on your tax return. Gambling loss deduction limitation. I throw this in not because I think we have a lot of gamblers out there, but just to show you some of the, in my thoughts, the esoteric changes that they have made. So for professional gamblers, in the past, they could only deduct their gambling losses up to their gambling winnings, but they could deduct related expenses such as travel, food, etc. That is no longer the case, and there are, just like everyone else, they will not be able to deduct those. Slight change to the charitable contribution deduction limitation. In the past, that's been a 50% limitation. They've moved that up to 60%. So if anyone is giving away more than 50% of their income, you can now give up to 60% and still have that tax deduction. The medical expense deduction threshold was reduced to 7.5% of adjusted gross income. I'm not sure why they did this, because it goes back to 10%. It was 10% in 2017. For 2018, it's 7.5%. But in 2019, it goes back to 10%. So I'm not real sure why they decided to do that. And then there's no dollar amount limitation on itemized deductions. In the past, if you're for high income earners, if you earned more than $300,000, I think it was $305,000 last year of income, then it was quite possible that your itemized deductions might be limited. They have removed that, and so there is no dollar amount of limitation on itemized deduction. But again, with the removal of the state and local income taxes, the eliminating of the miscellaneous itemized deductions, they probably felt like it was a non-starter anyway. Let's switch just a little bit and talk about the estates and trust taxation. I won't spend a lot of time on this because, as you'll see in just a second, it does not apply now to most people, at least on the estate side. It does on the trust. As you can see here, the tax rate comparison for estates and trusts has been reduced to 5 brackets now. So that's, I'm sorry, to 4 brackets. It was 5 brackets, now it's 4 brackets. So that's been changed. And also you may have heard that the exemption from estate taxes has doubled. So it's gone from $5 million to $10 million per person, and that's subject to the inflation index. That base exemption actually goes back to the year 2010, and so currently for 2018, it's $11,200,000 for an individual and $22,400,000 for a couple, a married couple. So you can see there that the estate tax, although not eliminated, is certainly going to be affecting only a much smaller number of folks. Talking about the alternative minimum tax, as I said early on, that remains in effect with an increased exemption amounts. You can see the table here. The increase of the exemption doesn't look to be that much. However, I do expect that a lot fewer people will be subject to alternative minimum tax than in the past. One of the items that they've done that will make it a little better is the phase out of the exemption. In prior years, the phase out for married filing joint folks started at $160,900. So that in old law 2017, you can see the exemption was $84,500. So if you had income below $84,500, you would not be subject to alternative minimum tax. However, that started phasing out at $160,900. Well, now they've actually moved that phase-out number to $1 million. So again, looking at the 2018 line there for married filing joint, you can see that the exemption is $109,400 before you even have to think about alternative minimum tax. That doesn't mean you'll be subject to it, but it does mean that you then have to look at it and see whether you're subject to it. And the phase-out now does not start until $1 million. And that's where I think it will mean that a lot of folks will no longer be subject to the alternative minimum tax. For other filers, the exemption phase-out was at $120,700. That's been moved to $500,000. Also, in this one, again, was a pretty limited where it ever came into play, but the medical expense deduction is no longer limited when it comes to AMT to the amount exceeding the threshold. So that's the same treatment as non-AMT taxpayers have had. Another provision that has gotten quite a bit of press is the child care credit increased to $2,000. I believe Senator Marco Rubio was the one that really got this pushed through, and it will be helpful to many people, and it will ease the burden a little bit of not being able to take the personal exemptions for children anymore. They have changed the phase out on this as well to the schedule that you see here, the threshold that you see here. So for a married filing joint couple, the phase out of the child tax credit of $2,000 doesn't start until $400,000 of income, whereas in past years it's been $110,000. There's also a $500 non-refundable credit for certain non-child dependents. So potentially if you're claiming your mother, your father, brother, sister, aunt, or someone that you do maintain the household for and claim as an exemption, you may get a $500 credit for them as well. And then the refundable portion is increased to $1,400 per qualifying child up to the base credit amount. Again, that doesn't affect, probably doesn't affect anyone on this call, but it could. And that is if your tax liability is reduced to zero, in part due to these credits, you may still get a refund of up to $1,400 per individual child. The kiddie tax has been modified. It's no longer taxed at the parent's rate. It's now taxed according to that new schedule applicable to estates and trusts. So instead of just having it added to the parent's tax, it will now be taxed at those much higher trust tax rates. 529 accounts have been expanded. They now include tuition at elementary schools, secondary, public, private, or religious schools. There is a $10,000 limit per tax year. In the past, these 529 funds could only be used for higher education beyond high school. Now you could actually use it for private school, at elementary or secondary, religious schools, it doesn't matter. They did initially include the expenses related to homeschooling, and I'm not really sure who pulled that out, which senator or congressman lobbied to get rid of that. However, that has been pulled out, and expenses for home schooling cannot be used out of the 529 plan on a tax-free basis. The next topic I want to briefly touch on is that you cannot recharacterize contributions between different types of IRAs after 2017. So in the past, what we've been able to do, if someone took an IRA and said they wanted to convert it to a Roth IRA, they could do that. And then later on, they could say, you know what, from a tax standpoint, that really doesn't make sense for me to do it, so I want to recharacterize it from the Roth back to the IRA. And there would be no tax consequences to that, everything. That would be just fine to do that. However, that has changed. Once you convert to a Roth, it's always a Roth. There is no recharacterization of those conversions. So that is something to be aware of. That brings me to the end of, well, I'm sorry, let me back up a second. I don't have a slide on this, but I did want to talk to you about some of the other education tax breaks. The final version does not have in the removal of the tax breaks as it was originally proposed. So specifically, the lifetime learning credit and the student loan interest deduction are still in place, and the exclusion for graduate school tuition waivers survives as well. So I did want to mention that. That brings me to the end of the individuals, and we'll move to the business in just a minute. However, I did want to take just a minute to talk about our iPad drawing that we will be having this year, as we've had for the last 3 or 4 years anyway. So if you bring us all of your material, not your W-2 only, but you've got to bring all your material into us, by February 28th, we will give you 3 tickets for the iPad drawing. If you bring it in by March 15th, we will give you 2 tickets for the iPad drawing. And if you get it to us by March 23rd, you'll receive 1 ticket to the drawing. And let me hasten to add that with all the tax changes and everything that's going on, we will have a little bit earlier deadline this year. So March 23rd is our deadline for us to have all of your information, where we, quote unquote, guarantee that the tax return will be done in time to file on April 15th. Probably a good time also to just talk about extensions. I'll take just a second for this. We run into people every year that we say, I'm sorry, you've brought your information in, you've gotten us your information on April the 7th. I'm sorry, there's no way we can do your tax return. We'll be happy to do an extension for you, but we will not have an opportunity to get it complete by April 15th. Some folks have basically said, thank you, goodbye, and I understand that. If they want to find someone else that can do it in the last week, that's fine. However, the other thing that I often hear is people being concerned about this being a red flag for an audit, or that it will cause some other, penalties or whatever. As long as we get you a valid extension, which means we basically say, hey, IRS, we want an extension to October 15th, then that you won't have any I'll get it out in a minute, any penalties for filing late. Now, you do have to pay what you believe your tax will be by April 15th. It's not a way to delay paying your taxes. Let me emphasize that. It's not a method of delaying paying your income tax. However, there are no penalties, no red flags for filing an extension. Quite honestly, I'd say in the last 20 years, I've probably never filed my tax return before October 1st. After doing as many tax returns as I do, I'm just not ready to do mine by April 15th. So anyway, I wanted to hit you with that, and then also to talk about our referral program very quickly. As you may know, those of you that have been clients of ours for a while, for every person that you refer to us and they become a client, we will give you a $50 credit on your tax return. They will also get a $50 credit on their tax return if they become a client. And let's see, other things I wanted to talk about was, again, the deadline for documents. Please note March 23rd is our deadline. The next section that I'll be going into is for businesses and business owners. Those of you that are individuals, if you have no interest in the business provisions, you're certainly welcome to drop off at this point. And as I said at the top, and I'll say it again at the end, but if you have any questions, please feel free to call Kristen Hensley in the office, 704-552-8689, and she can set you up with either a phone or in-person meeting with one of the CPAs or accountants in the office. Her email address is kristen@NewtonAssociatesCPA.com. Okay, let's move to the business provisions. What we want to look at for businesses is a few key takeaways. We want to talk about the net operating loss NOL modifications that have taken place in the new law. Chat briefly about the accounting method changes. Talk about depreciation changes. And a few other provisions that affect businesses. The first key takeaway that we want to look at is, of course, this has been widely discussed, but the corporate tax rate has been reduced to 21%. The top rate used to be 35%, and now it's 21%. The corporate AMT has been eliminated. Again, we don't find that coming into play for many of our clients. However, that is a new provision, so there's no more alternative minimum tax for a corporation. And I'm talking here about corporations that are taxed as corporations. We're not talking about sub-S corporations, which are pass-through entities, and we'll talk about that in just a couple of minutes. As a matter of fact, we'll talk about it right now. Pass-through income. This has been a huge item in the media talking about pass-through income and what the deduction for the income is. And I wish they had done what they initially talked about, and that was to say, okay, all pass-through income will be taxed at 25%. That would have been so much easier than what they did. What you've heard is that you will get up to, and notice that underlined, up to a 20% deduction for pass-through income. And that is a new section of the tax code. It's called 199A, Section 199A of the tax code. And in the new law, this simple 20% deduction takes 24 pages of the law. So trust me, it's not just a 20% deduction. What we do know is that there are several layers of limitations. There's a phase-in provision to a moving threshold dependent upon several other trade-specific modifications. And again, with it being 24 pages long, you don't want to hear me go through all of that specifics. Just let me let you know that we are aware of those, and that if they do affect you, we will certainly take that into consideration on doing your tax return. So here's what you need to know, and that is that 20% deduction is not guaranteed. Most people will get it, but not everyone. And until we actually look at the tax return, it's almost impossible to tell you whether you will get that 20% deduction or not. Let's talk briefly about net operating losses. Again, this would be for what we call C corporations, not sub-S corporations. So if your corporation pays taxes itself, this net operating loss provision applies to you. The carrybacks have been eliminated. We used to be able to carry back losses 2 years and then carry them forward for 20 years to offset income in other years. So if you had one really bad year, then this carryback could mitigate that, because you could go back 2 years, file an amended return, and potentially get back some taxes that you had paid in previous years. Under the new law, the carry-forwards can be made indefinitely. So again, no more carrybacks. Your carry-forwards can be made indefinitely. However, it's limited to 80% of your taxable income. And again, in prior years, any carry-forward could be done up to 100% of your taxable income. So if you had I'm going to try to think of this example on the fly. If you had a $50,000 net operating loss in the year 2017, under the old tax law, you could take that as a credit or a offset to your income of your 2018. So if in 2018 you had $50,000 of income, you could apply that entire $50,000 of loss carry forward to the $50,000 of income and have zero income for the year. Under the new law, it's limited to 80%. So in that same example, you would only be able to take $40,000 as a net operating loss deduction from 2017 to apply it to your income of 2018, so you would still have $10,000 taxable income. The other $10,000 of net operating loss would carry over to the next year. They did provide one exception. Property and casualty insurance companies are allowed a 2-year carryback still. They still have a 20-year carryover to offset 100% of the taxable income in such years. I hate to be cynical, however, how much do you think the property and casualty insurance company lobbyists had to pay Congress to get this special provision just for them? Okay, I'm cynical. It happened. Accounting method changes. Small business exception test is increased from $5 million to $15 million in gross receipts. And what that means is that in the past, if your income was your gross income, your receipts, was less than $5 million, you could use cash basis accounting. That has now moved to $15 million. You can still use cash basis accounting. This exception test applies in determining the ability to use the cash method, as I said, also for accounting for inventories. There are some depreciation changes that we want to take a look at. The bonus depreciation has been extended, and this means that you can immediately deduct 100% of your capital assets that are purchased through the year 2022, and then it gets phased down over the next 4 years to 20% can be written off in 1 year in 2026. But for the years 17 through 22, all capital assets can be written off in 1 year. This is a big one. The limitation on new property has been removed. In the past, this bonus depreciation only applied to new property. But now, if you buy used property, then you will also be able to take advantage of this bonus depreciation. The luxury automobile depreciation limits have increased. You can see this table. In year one, you can now take up to $10,000, and in year two, $16,000 and on, as far as depreciation on luxury autos used for business purposes, of course. Some changes in the Section 179 expensing. I think everyone in business certainly is aware of Section 179, and you probably call it 179, but it's basically where you were able to write off 100% of an asset in the first year, and again, that had to be a new asset. The maximum amount has now increased to $1 million. It's been anywhere from $25,000 to, I think the most it ever was $250,000. That's now increased to $1 million. The phase-out threshold is increased to $2.5 million, and that gets to be a calculation we have to make. If you have put more than $2.5 million into new assets, then you start losing some of the ability for that $1 million. The definition has expanded significantly. That could have quite a few folks have to be able to take this 179 expensing. Depreciable tangible property used to furnish lodging, improvements to non-residential real property. For example, roofs, heating, ventilation, air conditioning, and that sort of thing. So if you'll notice they're non-residential real property, this could be very beneficial to folks with rental properties. If you have to replace a roof, now we would be able to expense all of that in 1 year. Other depreciation changes that are involved, we do have qualified improvement property recovery periods have been shortened from 39 years to 15-year recovery period using the straight line depreciation, or if you're using the alternative depreciation system, 20-year. Again, these are somewhat esoteric. I know I keep using that word, but they are from the standpoint of not being utilized by every corporation, I guess is a way to say it. Other provisions that we have, the disallowance of deduction for net interest expenses exceeding 30% of adjusted taxable income. Again, if your interest expense is more than 30% of your EBITDA, then you will not, from 18 to 21, that's the cap. Beginning in 2022, you'll notice that it's just EBIT that it's capped at 30% of that. The domestic production activities deduction has been eliminated. That was one that not a lot of people were able to utilize. It certainly was utilized by large manufacturing companies, but not so much for smaller businesses. Fringe benefit expenses are limited. That does come into effect for a lot of folks. In the past, we've always talked about meals and entertainment being subject to a 50% limitation. You can only deduct 50% of those expenses. Starting in 2018, all entertainment expense deductions are disallowed. So no more deduction for football tickets, basketball tickets, any kind of entertainment at all. Those deductions are completely disallowed. Meals that have been expanded to include those provided on the premises of the employer. Again, in the past, there was an exception to the 50% rule that said if the employer had lunches or whatever provided on his premises or for his convenience, then that would be 100% deductible, and that has now been changed also to be subject to the 50% limitation. Deductions for transportation fringe benefits have been disallowed. So again, the business will no longer be able to deduct a transportation fringe benefit that they provide to their employees. At least the employee will not have to include it in income, so that's a good thing. And then another one that I came by my desk that I saw, I just couldn't understand why in the world they touched on this. But evidently there was a provision that if an employer paid up to $20 per month to an individual for riding their bicycle to work, then that would not be taxable to the employee. That was removed, and we're talking about a whopping $240 tax deduction per person. So I just don't understand, number one, why it was ever in there. Maybe that's why they took it out. But at any rate, that is also gone. There is a new credit for employer-paid family and medical leave. And the deduction is further limited for excessive employee compensation. Again, I don't think we have any current clients that this would apply to. Typically, it is for public companies, large public companies, that if you pay more than $1 million in salary to your executives, you were not allowed to deduct anything above that. And again, that's just been limited for excessive employee compensation going forward. Another provision, just to bring up briefly, S corporations are converted into C corps. All I'm going to say there is if you are a S corp and you convert to a C corp, there are some adjustments that will need to be made and potentially have some income within the year of change. Again, I just want to emphasize that we do strive to meet your needs. That's why I have these webinars from time to time, is to try to educate our clients and others as to changes in the tax laws. Just remember that everyone's individual family or business tax situation is unique. Certain aspects that we've talked about today may not be applicable in all circumstances. And again, please feel free to contact our office. Call Kristen at 704-552-8689 in order to set up a meeting or a telephone consultation with one of the folks here in the office. You may also email her, Kristen at NewtonAssociatesCPA.com. And with that, Jeff, I think it's been almost 50 minutes and my voice is about gone. So I'll turn it back over to you, and I want to thank everyone for hanging in with us today and appreciate it very much. Have a good day.
Thanks, Ed. Thanks for sacrificing your voice. We appreciate it. That certainly was an information-packed session. And before we close, I just want to remind you that the firm will be drawing for an iPad shortly after the April 15th deadline. As Ed mentioned, you can have multiple chances to win. If you deliver all of your tax information to the office by February 15th, you'll receive 3 tickets in the drawing. By March 15th, you'll receive 2 tickets and then 1 ticket for having your information to Ed in the office by March 23rd, again, which is the deadline for assuring that your return will be prepared by the April deadline. So you'll also receive a ticket for each new person that you refer to the firm that becomes a client. And as always, for each person that you refer that does become a client, we are happy to give you that $50 discount on your personal tax return. As Ed mentioned at the top of the webinar, the information provided may or may not be applicable to you and your unique individual circumstances. If you are a current client of the firm, you know that we welcome your questions. If you are not currently a client, we welcome you to call, again, Kristen Hensley at the office. That's 704-552-8689. Or you can email her at Kristen at NewtonAssociatesCPA.com. Kristen is spelled Kristen, again at NewtonAssociatesCPA.com, and she will be happy to schedule an initial meeting with one of our team members. So again, thanks for everybody for being on the call. Thank you again, Ed, and thanks everybody for listening. We'll talk to you soon. Bye-bye now.